Cool. Skyler, we just wrapped up with David. Fun conversation.
Yeah, it really was. I've kind of touched on a lot of different aspects of, the alpha capture platforms and specifically CenterBook, what he's built, and conversations about managers, how I did differentiate between who's good and who's highly skilled and who's not, right, over time. That's definitely a challenge and a conversation I've had with many hundreds of managers over the years. So it's definitely insightful from that perspective as well.
Yeah, for sure. We dive into the alpha capture a lot. We just talk about CenterBook, like their business model, how different like fund managers share their research with CenterBook and how they utilize that, and how it's also beneficial for the fund managers aspect.
Yeah, and even just, obviously asking about the AI narrative, how they're using AI internally, how they think about AI as a disruptor, and dealing with a lot of data. Obviously, they could see this as a big advantage, which they're using. Sounds like at a high level, which is great.
Yeah, absolutely. Well, there's a lot here. I think without further ado, let's jump into the interview.
Jump into it. That sounds great.
Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today we're joined by my co-host Skyler Steinke, and we are joined here by David Stemerman. David is the co-founder, CEO, and CIO of CenterBook Partners. It's a pioneering global buy-side alpha capture firm. So, David, thanks so much for joining us today.
Mike, Skyler, great to be with you.
Absolutely. Well, let's start off with your background. Tell us a little bit about your background, and then I'd love to come into, CenterBook Partners, how you guys started this, and, talk about what you guys do a little bit here.
Yeah, so my background is bottom-up stock picking, beginning my career as an analyst. And amazingly enough, it's a little back to the future. I started doing this in the summer of 1991 when bombs were flying in the Middle East, and seems like we're back to the future here. And did that really across sectors and geographies. Had the opportunity to work with Steve Mandel at Lone Pine Capital for several years, learning the craft and learning from one of the best in the business. Had the opportunity to start my own firm, KTI Capital, which at the time was the largest launch for a global equity long-short fund, investing across all sectors of the economy all over the world.
Very cool. And then CenterBook Partners. Let's talk about how did so you were working in the industry, long short equity. How did CenterBook, where did the ideas stem from?
Yeah, so very much came from my experiences at Canadas and Lone Pine, which is that I saw there's tremendous skill in bottom up stock picking, of identifying individual companies, industry themes that play out over quarters and years to make a lot of money. But what I saw was that in any given period, you might have a lot driving your returns that was different than whether you got your stocks right. And that could be like the environment we are in today with a war. It could be that the market became more growth-oriented or more value-oriented. And as I saw allocators wanting more and more in their hedge fund exposure to say, I just want pure alpha. I just want that stock picking exposure, and I don't want this other stuff. I thought there was a real opportunity to create a business to partner with managers like myself at Canadas that had these long-term investment time horizon, but could work with them as a partner and deliver a return stream that the allocators are looking for of this pure alpha return stream. And I'd say the other aspect of it was that I saw a lot of these managers like Canadas having more and more trouble with their own businesses, that the allocator community was increasingly moving towards multi-managers. They were moving to low net, equity market neutral, and a lot of managers that are incredibly talented, who are delivering great returns, are struggling to raise capital, struggling to build their businesses. And so the other piece of this was, how could we be a great partner to those businesses? How could we effectively help them access that capital that they couldn't address in their own strategy? And how could we also give them some of the tools, some of the support that they would have if they were part of a pod, some of the risk analytics, some of the coaching that they don't have being independent because they want to be independent. They don't want to be part of a pod. They want to stay on their own. They want to invest the way they want to invest with a longer term time horizon. How could we be a great partner to them and to their investors so that they could stay independent and really thrive?
Mm-hmm.
Yeah, that makes sense. What from that view, David? How do you evaluate the manager side of things? And with the partnership, what does that look like? What does that model look like for you?
Yeah, so one of the advantages that we have at CenterBook is that we are partnered with a software company called Alpha Theory, which the background of Alpha Theory is that it's a great tool to help managers with their position sizing and running their portfolio. And I know it well because at Canadas, we were power users. And the idea behind Alpha Theory is that you got a lot of analysts with a lot of ideas, and they have price targets and different ways of looking at stocks. How could you put all of your research information in one place and get it similar across all of your contributors with a model portfolio based on your price targets across all your managers? And so what Alpha Theory has that's amazing is years and years of data for hundreds of managers of both their actual portfolios and their price target research. So we have this gold mine of information to answer exactly, Skyler, the question you asked, which is, okay, who's good? What are you looking for? And we had a bunch of ideas about what that might be, but some of those ideas are right, some of them are wrong, and we were able to validate it. And one of the ways that we found was a really powerful way to evaluate manager data was to look at their full portfolio holdings every day through the lens of a risk model. And so this is like a little bit of that plot twist. So when I was running Canadas, what I really focused on was getting my stocks right, one stock at a time. I was aware of these factors like momentum and value and growth, but that wasn't the core part of what I was doing. What we find is that if you can look at a manager's return stream and strip out that factor noise, you can isolate if they're really good at picking stocks. And so that's what we're able to do. The other thing we're able to do is for these research intensive managers, we're able to see do they do the work with their research in a way that shows they're really process disciplined and they likely are going to be repeatable in what they do. And one of the analogies that we use is that doing the work of every stock, having your models, doing a price target, it's like not only going to the gym regularly, but not missing legs days. And so you got to put in that work. And so what we're able to do is to see, well, what percentage of your stocks have price targets, and how frequently are you updating them? And so these are two great lenses, and we've seen that if you're able to generate idiosyncratic returns in your portfolio, if you do research on a repeated basis, well, that's a great place to start. And those are really powerful differentiators in how we go about identifying which managers we want to work with.
Yeah, no, that's great. I guess going back to what you talked about from a data set point of view, you have a lot of data now over a decade, potentially, with hundreds of managers.
Yep.
What patterns have emerged about what actually drives durable alpha? What have you seen to this point?
Yeah, so part of what we see is that it comes in all places. It comes across sectors, it comes across geographies, and this concern that equity long short might be dead, we feel like the Mark Twain quote, rumors of my death are much exaggerated. That's not true at all. There have been some tough years for equity long short managers. 2022 in particular was a tough year. But if you look at the data and you isolate this idiosyncratic return, there's a lot there. And it's a very different type of alpha than what these managers that are on the multi-managers doing much shorter term relative value trades. So one of the research insights that we had early on was seeing, well, if you looked at a position's alpha, was it just for a few weeks? Was it just around earnings? And we saw, no, actually, our managers can generate alpha that goes up and to the right for quarters and quarters on end. And that really very much rhymed with my experience at Canadas, which is that the investment thesis that I would have would not be around the next catalyst. So Canadas pitched at the Irisone conference shorting a South African consumer finance company called Africa Bank. And my thesis was that their underwriting practices reminded me of the subprime mortgage underwriters, and that they had a funding model that reminded me of Lehman Brothers, where they were entirely dependent on the capital markets. And I said that's a pretty toxic combination. And I don't know when the lighting of the flame is going to cause this to blow up, but I'm pretty sure that it's going to. And that's the kind of investment thesis that our managers have in their portfolios. And we've seen that again and again in the data. And it's a super exciting source of alpha for us to partner with these managers on and deliver it to these allocators that increasingly they don't have it in their portfolio anymore. A lot of allocators have moved away from traditional equity long short. They've got a lot of exposure in the multi-managers or these low net, and they really don't have much of this left. And this to me is real investing. This is maybe again it's old school, but we see in the data it's alive and well.
Absolutely. There's a couple threads we could pull on here. Let's talk about kind of how the market is, in your opinion, shifting back to the fundamental side of the business. How do you see the market kind of, you mentioned here, like there's been kind of a lack of allocation towards like long short managers. Do you see the market, shifting back toward the fundamental side of things?
Yeah, so it's been, the environment has been tougher for this mid to long term equity investing. Certainly since COVID, and I would argue it's been tough even since the financial crisis relative to the glory days of the mid 90s to financial crisis, which was the period that I grew up in. It was the period where the Tiger Cubs burnished their reputation, years like 2000, 2001, 2002, where the market was down every year, and most of these funds were net long and made money every year, and also made money in the late 90s, made money in the 2000s. This is your dream as a hedge fund investor. Say, oh, these guys can pick stock, can make money anytime. That didn't prove to be the case in the global financial crisis. It's been tougher, and then in 2022 was in many ways the year a lot of people threw up their hands, where the market was down, and a number of these funds, they were down even more than the market. Like that's not what's supposed to happen with a hedge fund. So what I see is actually three different developments that suggest to me that we may be having a regime change where the environment going forward may be the best it's been since the financial crisis. And if you'll bear with me, let me give you three thoughts, and maybe we can dive into them. The first is that it's been a pretty narrow market for a long time. And the reason for that is the economy has been sort of tepid for a long time. And there are a few metrics on that, but while earnings growth has been okay for the S&P 500, for the average stock, there's been basically no earnings growth, 22, 23, 24 into early 25. And if you think about the earnings growth coming out of the global financial crisis, pretty soggy. And so, okay, if you're a TMT investor, not so terrific if you invest in consumer and industrials, financials. The second is that you want to have financial conditions that are on the one hand good for your longs and on the other hand good for your shorts. And so what I mean by that is you want to have a yield curve where it's positive interest rates, it's upwardly sloping, and it's high enough that there's a cost of capital. And that on the one hand is an indication the economy is broad enough, strong enough so that businesses across sectors can grow. And that if business is challenged, you've got a cost of capital that's going to cause the share price to go down. And then the third piece is, wouldn't it be nice to have a broadly disruptive technology? That was a key part of the magic for the second half of the 90s and the 2000s. This the Netscape IPO in the mid 90s was a big moment. And what was exciting about that was that not only did it create disruption in technology, it was very broad based. So you had in media and retail, lots of areas, lots of change. Well, there's a little discussion about this thing called AI, and we had a similar moment with ChatGPT, and that is now not just relevant for tech investors. It's now pretty broad-based across sectors. And that's going to create the kind of big secular winners and losers that create a great environment for stock picking. So we began to see all those three things coming together the back half of last year, and it turned out to be a great year for equity long short, and allocators are starting to notice. You've finally gotten some inflows in equity long short as there's sort of sniffing out that maybe there's something here. A last indicator of this is Morgan Stanley, their prime brokerage data, they measure something called their long-short spread, which is if you just look at what's the return on your longs, what's your return on your shorts, how much spread is there, that's sort of the core driver for equity long-short managers. They've been keeping these data since 2010, and for 2010 through 2024, it was up about mid-single digits, which is okay, but not nearly as good as it was before. Last year, it started off tough, and by the end of the year, it was up high teens. So an indication that there's something going on. Now, that won't be true every month, every quarter, but I think we're seeing something that's a structural shift that is very, very encouraging.
Absolutely. And you see AI being a big part of this, especially for the firms that maybe haven't participated as much, up till now. And it's obviously a newer technology, but you kind of see this being a bigger shift for some of those companies that have been left out.
Absolutely. So what we're going to now is a period where adoption for AI is becoming much broader. And that is true really across lots and lots of industries. And what we're seeing is those that adapt sooner and are forward-looking can be big winners, and those that don't figure it out and are laggards, they've got a problem. And it's the analog that perhaps is we've seen before, just to orient everybody, is in retail. And so here it is. It's obviously a long time since the internet. But the idea was, the internet, it's all going online, and if you're an on-ground retailer, you're dead. Well, the answer is not really. There have been winners and losers, and we were able at Canadas to make money long and short in exactly that area. And you just look, even within the last 12 months, this is now 30 years in, look at the difference between Walmart and Target. And one of the key differences is Walmart has done an awesome job. Took them a little longer, but they're doing an awesome job. And Target is lost. And these are two companies in sort of similar businesses. And what a great way to make money long and short between those two. And I suspect we're going to see lots and lots of examples of that in AI across lots of sectors. And that is that's equity long short nirvana. And this is I continue to while I run a systematic fund, I still love stocks. And so I get the research about what are the themes and the ideas for the year ahead. And as I looked at that, I was thinking, wow, this would be a great time to be running an equity long short fund. It's been a long time since I've seen so many sectors with so many interesting things going on. And not just by sector, also by geography. If you think about Europe and Germany and Japan, they've been dead. They've been static. There's been nothing going on for such a long time. And finally, you're beginning to see some life breathed into those parts of the world. And there are amazing economies, amazing businesses, amazing potential dynamism that I think is just beginning to be unleashed.
Yeah, definitely very exciting on that side of things for sure. Obviously, with AI narrative globally, it's definitely bringing up a lot of different nuances, some disruptive, some opportunities there. From an allocator point of view, I know you mentioned there's some different things there you're seeing in the marketplace and what they're looking at. When allocators are looking at diversifier buckets, for example, what do you think they own versus what they actually own? I mean, there's some nuances there with what they think is truly diversified in this market. I'm just curious your thoughts.
Yeah, so this was this was an education for me of in 2008 with the financial crisis. Is that was the year not only that I started Canadas, but it was the year that I was asked by my girls' school, Greenwich Academy, to chair the investment committee. And I was handed the keys in the fall of 2008. Welcome to the show. And so there were a whole bunch of hedge funds in that portfolio that had done incredibly well. Many of them, as you might imagine, well-known friends to the members of the investment committee. And we saw that it was a lot of these performed very differently during that period of time. And the idea then became, okay, for my hedge fund bucket, you Skyler, talk about it, it should be a diversifier. And what are you looking for? You're looking for something that's uncorrelated to the equity markets and ideally uncorrelated to whatever else, and that's going to deliver you a consistent return stream in a wide range of environments. So the way that the hedge fund industry is developed and the multi-managers that are multi-strat have been most successful is delivering exactly that. And this is an area where the traditional equity long short model, where I'm a mid-net manager, I'm not really focused so much on managing factors, that's been less effective in being truly uncorrelated. And so that's part of the reason that you've seen allocators moving in more and more money to that multi-manager, multi-strat, and having less and less of that directional equity long short exposure. But what that's resulted in, I think, Skyler, this is your question, is, well, now you sort of got a lot of that and not much of this anymore. And so the multi-strats are increasingly getting into similar businesses and similar trades. And you're seeing more and more correlation among them. And for the equity components of it, you're seeing with the very strong focus on being market neutral and factor neutral, what that typically results in is a much shorter, more tactical alpha. And it's not that the people working there don't have a thesis necessarily that's longer term, or not that these are some fabulous investors, but they're almost forced by the constraints of market neutral, factor neutral drawdown limits to have a much more shorter term tactical alpha. And the model's been so successful, you've got lots and lots of capital behind it. And so I think allocators are increasingly say, well, this has been very good to me, and I love it, and I got a nice slug of my capital here, but maybe I've got either too much of this or I need something else. And the something else that we're able to offer in partnership with these independent managers is that fundamental mid to long-term alpha, which is increasingly missing from their portfolios. And what we've seen is in looking at the returns from that mid to long-term alpha, the correlation is very, very low relative to what they currently have. So if you're looking to build a diversifier portfolio, you're looking not only to diversify relative to the broad market exposure, you're looking to diversify to other things you've got. And so an important part of what we think we can do is we can actually bring these equity long short managers that a lot of allocators, they say, I love this alpha, but I don't know how I can get access to it. And with CenterBook, by partnering with them, by tapping into that long-term fundamental alpha for their stock picking, by getting access to their research and using best practices in systematic portfolio construction, we can isolate that alpha, we can amplify it, and we can deliver it in a pure return stream for the allocators. And then we share that back with the contributors in a partnership-centric approach. And you get the alpha, those managers get more money, they get support from us, and that source of alpha, which has been so important historically, we can help the managers be healthy and grow, and we can deliver that return stream to the allocators.
That's great. That's great insight there. From alpha capture platforms like CenterBook, how do you see that your platform evolving as the hedge fund industry continues to institutionalize? What are some nuances that you see, or what do you see kind of the 5-year runway, if you will?
Yeah, so we actually just had an internal meeting where we've talked about this is we started this up literally as a startup. It was a pioneer in buy-side alpha capture, dedicated to that mid to long-term equity alpha. And when we did it, a lot of people, they didn't even know what we were talking about. And so in Europe, where sell-side alpha capture, the pioneer Marshall Wace did a great job, has delivered phenomenal returns for decades. People knew about this idea of alpha capture, of, you can have outside contributors give you insights about stocks. You can then have a central systematic firm evaluate the data, build a return stream, make it work, and then they can get contributors to join them because there's a good value proposition, and the whole thing works. When we said we're doing buy-side alpha capture, particularly in the United States, people sort of looked at us and said, what are you talking about? And so now we're 5 years in, and it's an idea that whose time has really come. And so you've seen others also doing buy-side alpha capture. Marshall Wace has a buy-side component. There are others in the industry, some in London like them. But when we now go to managers and say, we'd like to partner with you, we'd like to have access to your portfolio data, we'd like to have access to your research, and we think we've got this great model of how we can help you be the best you can be. We can protect your LPs from any potential market impact, and this can be a win-win-win. People are saying, okay, well, I've heard about this thing. I've heard about this buy-side alpha capture. Tell me more. Let me know, how would this work for me? How would this work for my LPs? And so we've been able to grow our manager count from initially 25 we're on our way to 50. We have plans to be 100 and beyond. We think about partnering with these managers, not only joining us in our core funds, but maybe partnering with them to build single manager versions of their strategies, where we combine alpha that they generate with our systematic best practices and deliver them in ways that can really help them raise capital. And we think for allocators, they who saw CenterBook and said, okay, well, this is a pioneering strategy. Let me see if this works. Well, It does. So we've been at it for several years. We can share that, and we can share how we've really progressed. And if you think about building a multi-manager business, building a quantitative business, this is not snap your fingers overnight and it works. This is not saying, okay, when I ran Canada, say I know the playbook from my time at Lone Pine. I'm going to follow that playbook, and we're going to hit go code. This is different. 25 managers to start was minimum viable product. As we get to 50, that's a big step up, and as we get to 100, that's playing in the big leagues. And for our quantitative strategy, we had something that got the job done. We had objectives of what we would deliver. We've been able to deliver that. But we were on and continue to be on the steep part of the learning curve of making that strategy better and better and better. And so as we think about the returns potential on a go-forward basis, that combination of a higher manager count and investment strategy that's gotten more mature is terrific. And both of them, they're evergreen. And so the thing that's exciting about it is that we think this is a self-reinforcing cycle. And as we have more and more success, we're going to attract more and more managers, and we're going to get more and more data to figure out how to make the strategy better and better. And so it should be a reinforcing cycle that gets better and better all the time. And our model is we look at a business like what Marshall Wace built in Tops, and this has now been a successful business over decades, managing tens of billions of dollars, delivering wonderful returns for their investors, and delivering wonderful economics and insights for their contributors. That's really our model for we'll do on the buy side what Marshall Wace has accomplished on the sell side.
And let's talk about the research aspect, because that's really interesting to me. So you guys get this research from all these different fund managers. How, kind of talk to us. Somebody gives you the research, kind of where does it go? Do you guys, kind of just use that research to, make the strategy a little bit better? And obviously, maybe you get research from, you got 25 right now. I assume these are good high quality managers. Let's say, you get 200 one day. And obviously if you got, 200, it's a bigger pile where some of these aren't going to be as good. So kind of, somebody gives you the research, kind of, what do you do with it? How do you take that and talk to us about how it benefits them as well?
Yeah. So the research is like gold. And this was actually, as I think about what attracted me and our team to do this idea that we could see not just how the managers have run their own portfolio, but we could see what did they think stock by stock, what would be the ideal position sizing based on their bottom-up research and done in a systematic, codified fashion. It's the kind of thing it's sort of like a dream come true. And this tool was developed by Alpha Theory to help independent managers size their positions. And so Canadas, we were, as I said, a power user. And the idea was to say, okay, when we look at a stock, first we do quantitative research. We have a model, and we don't think that there's only one way this could turn out. We do multiple scenarios, and we have a base case, an upside case, downside case. We have probability weightings to them, so we can get a probability weighted return. But we said, but that's not all. There's also some qualitative aspects of this. What do we think about the management team? How good a business is this? How far along are we in our research process, and how much conviction do we have? And then there's a third piece, which is, well, how do I think about how this fits into my portfolio construction? Is how big is a top position? How big am I willing to have a position? How much am I willing to lose in a single stock? And so the beauty of this Alpha Theory research is it collects all that data, and then the portfolio manager fine-tunes it to then develop a model portfolio, where the model portfolio is really representing how the position sizing should work based on that bottom-up research. And each manager is different in how they think about the world, which components, how they weight it, but they all are in common saying, I want to make the most money possible, and so I want the best optimal portfolio. And what Alpha Theory saw in its data, and what we validated at CenterBook, is that optimal portfolio is awesome. So if you look at the returns that the managers generate in their actual portfolio relative to their optimal portfolio, the optimal portfolio is outperforming by hundreds of basis points a year, on average 400 basis points a year. And the reason for that is that if you're a bottom-up stock picker, like I was at Conatus, there are a couple of constraints you have in following that optimal portfolio. The first is that you're not building a portfolio one stock at a time. You have to manage the risk of the portfolio of how it all fits together. And so this optimal portfolio tells you, well, if I only did one stock at a time, what it would look like, but it's a portfolio that does have more risk. And so it was a conundrum for Conatus and a conundrum for our managers that use Alpha Theory of like, I see all this other alpha, but I can't access it myself. The other piece is that it does ask for a fair bit of trading activity. And while we were good at a lot of things at Conatus, timing our trading and getting that most efficient, I'd say we were good, but it wasn't our core competence. So this is where CenterBook can be a wonderful partner. We can say, okay, well, we're going to draw in stocks from lots of managers. So instead of having 20, 30 longs, 30, 40 shorts, we have hundreds of longs, hundreds of shorts. And so we can then say, yeah, we're going to size the position exactly based on how much alpha is there. And your research, that's going to be a great insight for how to do that. And then we can take care of all of the factor exposure, the market exposure. We can manage all that risk. And then we can figure out how to trade this in a really, really efficient way so that we can really bring together the best of what humans do and that unique research and capture this alpha in a way that a single manager really wouldn't be able to do on their own.
Got it. Yeah, and for that single manager, I guess, are as you help them optimize their portfolio, are you guys looking like maybe a single manager gives you here's like my top 30 stocks? Are you guys kind of using that as their universe, or are you guys saying, hey, you guys are maybe missing this opportunity from another stock that based on some of this other research that we have?
So one of the things we're very careful about is that each manager's data we keep just for them. So, but what we do is we can share with them insights of how we make the most of their data to help them out. And so one of the tools that we provide to our managers is that we give them what we call risk-adjusted optimal. So they have their actual portfolio, they have their optimal portfolio from Alpha Theory, and then we say, well, let's try to integrate the two, of saying, well, if you wanted to lean into your Alpha Theory research, but to be conscious of how this might affect your risk overall, what would a portfolio like that look like? And we provide them with some additional analytics that help them think about, well, why is that? What is it that my research is telling me? What is it that this risk model is telling me? And why might this make sense? And so we're helping the manager in a purely discretionary way. We're not saying, we're not telling you should just follow this portfolio systematically. We're giving you the insights of where you're likely to make more money and how you can do it in a risk-efficient fashion. And that we think is best practice in portfolio construction. This is the kind of stuff they do at the pods. Is that at the pods they provide managers with these risk tools. They show them the trade-offs, and they really help them move out the efficient frontier. And that's one of the advantages that you have when you join a pod. And when you're an independent manager, you don't have those resources. And so the idea behind CenterBook is we want to be the partner of choice we want to give you access to the kind of tools, analytics, consultative services that you would have if you joined a pod, but you don't have to join a pod. And for a lot of managers, they just say, this market neutral, factor neutral, low drawdown, that's not for me. That's not what I do. That's not how I invest. But I would love, love, love to have that additional kind of tooling, and that's what we're able to provide.
Yeah, that makes a lot of sense. I kind of mentioned, even when the manager's idea is correct, oil can still leak in all through sizing, exposure, many different ways. Where do you see that leakage, if you will, most likely happening? Or, is it also ultimately about better ideas or better implementation when it comes to alpha capture?
Well, so the most important thing, we talk about repeatedly, that our strategy is alpha capture, not alchemy, is you got to have something to work with. And so
Right.
It's important to get managers that really are good at what they do. And this is really in terms of when we look at their portfolio and we look at it, as we talked about before, through a risk model, are they able to generate idiosyncratic returns in their own strategy? And what we find is that's a skill that is often persistent and repeatable. And what happens is that most managers, they do have a way of looking at the world, and that does lead to some tilts in the portfolio. And for Canadas, my orientation was I was, like many Tiger Cubs, was more growth oriented for my longs. And the businesses that I was short, I tended to look at businesses with structural challenges. So that would mean I might have a little more of a value bias for the shorts. And during periods where the market shifted strongly in favor of either value or growth, that might exaggerate what was happening beyond my acumen in picking stocks. And so part of what we share with our contributors is to help them just be more conscious of that. And they may say, look, this is who I am. My investors know that's who I am, and that's fine. That's how I'm going to run things. Or they might say, if I can do something at the margin to have that be less of my returns, and I can have more of it focused on the great ideas that I have, that'd be great. If you can figure out some way that this alpha theory research that I know is great for position sizing, if I can figure out how to incorporate it more in my portfolio, well, that would be terrific. And so that when you do all those things, the returns are more likely to reflect that underlying skill and have less impact from these other areas of potential leakage that can muddy the returns and create some unease among your allocators and really let what you're really good at shine through. And that's ultimately part of the motivations for this was that I view these independent managers. These are my people. This was me. This is who I grew up with. This is and I've seen a lot of them struggling, and they say, oh, my returns are really good, but I can't attract as much capital as I would think that I could or should. And that helping with this awareness, helping them with their own portfolio management can help them manage that return stream better. They can tell their story better. And then we can also provide them with additional ways to monetize their insight in partnership with us and the funds that we run.
Yeah, definitely. And this has actually come up quite a bit. You mentioned one element, which is the skill point of it, right? Stock picking as a skill versus just a manager who has had some favorable market conditions. How do you separate the data attributes one versus the other as you go through that analysis on your side for evaluation for managers?
Yeah, so I'm firmly believe that this is a skill, and so it's an interesting. My first exposure to seeing markets through the research lens is I was a senior in college. I was taking a class that was known on campus as Stocks for Jocks, and it was taught by the one guy on campus who wore a suit. He was recently from Salomon Brothers. His name happened to be David Swensen, the CIO at Yale. And
Yeah.
the first book he assigned us was Burton Malkiel's Random Walk on Wall Street. And the opening scene is a monkey throwing darts at the Wall Street Journal. And what it said is the average monkey does better than the average mutual fund manager after fees. And so my whole career has been about can you outperform the monkey? And so the answer is it's tough. On average, the industry does not outperform the monkey, but some people really can. And that real skill has been obscured by market and factor exposure. And one of the really big advantages we have at CenterBook relative to allocators is that we're able to see daily position level data through a risk model. And it can sound word salady, but it's actually a really big deal. If you're in the position of most allocators where you just get the final returns and you're getting them monthly, maybe weekly, it's sort of tough for you to answer exactly the question that you posed, which is this manager really any good? And just because they generated the disclaimer, past performance is no guarantee of future returns, right? Some managers say, they did really well, and then they're terrible in the future. Some managers that did seem to have done really badly. So what is that all about? So when you're able to look at it in this very granular fashion, you can identify the idiosyncratic returns on a daily basis. You can see the level and the persistence of that return, and that's a really, really powerful indicator. And then if you can also look at their process discipline and see, are they doing this research? Are they doing it for most of their stocks? Are they doing it, updating it on a regular basis? You then become the card counter at the casino. And I remember, I don't know if you guys read the book or saw a movie of Bringing Down the House. This was the MIT students who hit the casinos. And it's not like
Great
they
movie.
got it right. What's that?
Great movie.
Great movie, right? And it's not like they got it right all the time. But if you can tip the scale in your favor, you can make a lot of money. And that's what Marshall Wace demonstrated with sell-side alpha capture. And what we find is that if you've got someone who's able to do these things on a consistent basis, they're likely to persist. And as we look to pick managers, we think we have a real advantage in identifying managers that are able to generate alpha on a persistent basis. And then we can partner with them to isolate it and then amplify it and deliver it in return streams that the allocators are very excited about.
With what belief about the hedge fund industry that allocators still hold, but you think is outdated?
It is that equity long short is dead, and there's no way to make money with mid to long term stock picking. I think those ideas have been informed by an incomplete set of data to reach those conclusions. And that's what we were just talking about, which is that if you're looking at data, total returns, you may get the wrong idea. And so following a period where, as we talked about earlier, it's been a less good environment structurally for mid to long-term alpha. You've had a fairly tepid economic environment, which means that the market's been narrow. You haven't had positive interest rates to put pressure on shorts. You haven't had this broad disruptive trend. And so, on the one hand, it's sort of right that equity long short hasn't been a great source of alpha. And then you look at question that Skyler asked earlier about this idea of, well, is it a diversifier? And you look and you say, well, what? Not so much. In the times where I really needed a hedge fund to be a diversifier of 08, 22, equity long short, didn't really get the job done for me. And so that's then been, I think, conflated with the idea that there's nothing here. there's no alpha. The strategy, it's all been competed away. There's nothing to do. And my view is exactly the opposite. That there is a lot of skill here, and now the time is coming back where this can be a really great alpha return stream, and it's at a time where many allocator portfolios don't have this anymore and are pretty loaded up on and with strategies that are pretty correlated to one another. And so you often find for people that they're fighting the last war, and that's where a lot of allocators' portfolios are today. But I am encouraged by seeing that allocators are seeing signs of life, and we do see that they're beginning to move. And so we did see some data that equity long short had its first inflows last year for many years. We see the levels of interest in the strategy is higher. So I think there's an openness to sort of thinking maybe things are beginning to change. And our hope is that we can play an important role in bringing that insight to the market. We can be a key supporter to these independent fund managers so that they can have the tools and resources to thrive, so that this equity alpha is available for allocators in the years ahead.
It's good. Yeah, I think you paint a good picture of why this is, it's different than it's been. Even just things like rates, which makes a lot of sense. I want to ask you. I'm sure we've touched on this a little bit when it comes to like research and whatnot. But is your team using AI in any interesting ways?
It is. For us, the main source that is helpful to us is using tools that help with productivity. So a lot of the highest and best use for these tools is in coding efficiency. And so, as you might imagine, for CenterBook, we're a systematic investment manager. So we have lots and lots of data that we're evaluating, and we get a tremendous amount of value from these AI tools, helping us structure the data and then analyze it. So the productivity of our team has increased quite significantly. The other is that the ways that we're able to analyze that data, we also are able to use these more advanced tools. So the typical way that we think about this is very much a linear relationship, and so I'm not a stats guy by background, but I know the basic concepts of a linear regression analysis and how one variable affects another. Some of these tools allow you to think about multiple variables and how they can interact in ways that are not just linear, but that align with intuition and make sense for how you would put a strategy together. So those can be a couple of uses that are very helpful for us. Yes and yes. So our view is that it will for sure be both. And we view that there are independent managers who deliver phenomenal return streams that are exactly what some allocators are looking for, and hopefully with our helping them be the best they can be, they will grow that business exactly as it is. We'll find that there are some managers where partnering with us for a systematic version of their strategy might deliver it in a way that is of interest to other types of allocators, and that will help individual managers grow their business by basically putting them in business with new products. And then the last will be there are some allocators who really love these multi-manager platforms, and they've seen how they've delivered wonderful, consistent return streams, and they love it. And so we think buy-side alpha capture will be one of those mainstream staples for their portfolios. just as they think about sell-side alpha capture is a great source of returns. There are a number of other systematic strategies that have become proven and are staples. We think that this will be too. And we think that it can serve both in the diversifier area, which we've talked about, which is the market neutral, factor neutral. We think there's also a role in the active extension area. And that's a topic we haven't talked about, but maybe we'll spend a moment on, which is if you think about the allocation for someone with a lot of capital, for sure they care about the diversifier component, which is where hedge funds have typically found themselves. But the much, much larger allocation is their equity exposure. And many, if not most allocators have said, well, the most that I can really hope for is the market return, and I'm going to put most of my return in indices because active management hasn't delivered me much return above the index. Or if I'm investing in a single manager, it's so concentrated, I'm getting a lot of variability, and I really prefer the value proposition of just getting the index over time. We think that the really, really big idea is how can you marry this bottom-up fundamental stock picking with a systematic approach to portfolio construction so that in active extension, you can have your cake and eat it too. What do I mean by that? Where you can have a return stream that tracks the index closely, but with alpha on top of it. We think that that's actually the biggest idea going forward. Just going back to my time at Greenwich Academy, while we were for sure interested in solving our diversifier bucket, the most important driver of the returns of the endowment was if we could get that equity component with alpha on top of beta. And so we think it's a huge idea. The attempts that fundamental managers have had to do this on their own of using leverage, this was a 130-30 fund or a 150-50 fund. The challenge historically has been that if you're not very sophisticated in managing factor exposure and beta in tough market environments, these strategies did really badly. They did really badly in the 08 downturn, which basically set them back for like 10 to 20 years. And so the idea is if you can use systematic best practices in managing that factor exposure and market exposure, and if you can diversify effectively, you can really deliver something quite special. And for the allocator community, whether it's a pension, an endowment, a sovereign wealth fund, these are very, very, very large pools of capital. And we actually think the highest and best use for this fundamental equity alpha is going to be on top of an index return. And one of the ideas I shared with the prime brokers is their business has gotten somewhat mature and developed in that diversifier bucket. The hedge fund business is still growing, but it's fairly mature. But this whole area of active extension, where they effectively can take share from the long-only community and deliver a much more performant return stream, we think that the next 5 to 10 years, that's going to be the big story. And we think that CenterBook Partners is going to be a critical facilitator working with these independent managers to help them capture that opportunity going forward.
This is good, David. This is really good. I think this is a good spot to wrap up. I really appreciate you joining us, sharing your insights today. Where could people go to connect with you and learn more about CenterBook?
Thanks for having me. You can reach us on our website at www.centerbook.com. We'd love to hear from you. We're constantly talking to new managers. We're eager to have managers join us, and those that are interested in our funds, we'd love to hear from you as well.
Awesome.
Terrific. Thank you both very much.
Awesome. Thanks so much, David.